Ladies and gentlemen, there's a lot coming out about the US dollar and how nations are ready to ditch the dollar, and they're ready to do it now. Now, in the past, America would kill world leaders that would talk like this. Is what happened to Gaddafi. But when it's a collective of nations, I don't know how you're going to kill that many world leaders, America. I'm just saying. I'm just saying. So anyway, there's several nations now. I mean, that's a whole heaping of killing if that's what you want to do, but I don't think you're going to be able to pull it off with so many different nations trying to do this at once. So anyway, let's get into this story. And I got another one that I will probably put out in about a day. So, the US money supply falling at fastest rate since the 1930s. US money supply has fallen at its fastest rate since the 1930s, a red flag for the economy and financial markets. Money supply has now been shrinking year on year since December, and they're talking about December 2022. An unprecedented development in modern times that should make investors sit up and take notice. Growth, asset prices, and inflation could all weaken. It is largely a consequence of a reversal of the liquidity generated by massive post pandemic fiscal and monetary stimulus. The Federal Reserve shrinking its balance sheets via quantitative tightening, falling bank deposits. Remember, I told y'all that bank deposits are moving out in mass numbers from small banks to more mega sized banks. And it's not just that. Some people are pulling their money out altogether and not going to other banks. So you got a bunch of things going on all at once right now. And weak demand for and provisions of credit. So it's virtually not a lot of lending going on in the US right now. All else equal, it is a sign the Feds has no need to raise interest rates further. Given the lag of 1 to 2 years between money supply changes and the impact on asset prices and inflation. It may even be a sign that the US central banks should be cutting rates. Fed data on Tuesday showed that M2 money supply, a benchmark measure of how much cash and cash like assets is circulating in the US economy, fell a non seasonal adjusted 2.2% to $21.099 trillion in February from the same time period a year earlier. So it's not as much money circulating in the economy right now. In seasonal adjusted terms, M2 money supply fell 2.4% from the same time last month. So that was before March failures of the Silicon Valley Bank and Signature Bank, both in the top 25 banks in the country, have fanned fears of a credit crunch, stoke market vitality, and prompted temporary emergency liquidity measures and backstops from the Fed's worth hundreds of billions of dollars. So they were saying there were a lot of problems even prior to the banks collapsing in the economy. And I've been saying it all along. This economy is not doing as well as they're trying to tell us. That's one thing. We got people in charge that just don't know what telling the truth is. They just don't know what the hell that is. So, Matt King of Citi in London, an expert on capital flows and liquidity, says if money supply growth can reasonably be seen to expand liquidity and fuel inflationary pressure, then the opposite should be true. M2 is the driver of broader asset price inflation, consumer inflation, equities, and real estate. It is sending quite a negative signal for all of those now and will likely feed through a broader economic weakness. M2 measures the nation's overall stash of cash, coins, bills, bank deposits, and money market funds. So, and it's basically the broadest measure of cash and cash like liquid assets. So, as long as people are feeling uneasy in this country, which I can understand, you see a failing bank and then you see another and then another, yeah, anybody is going to pay attention to that. So, right now that is having a terrible impact. All this money being moved and transferred all over the place is having a terrible impact on the economy. Money growth started slowing in early 2021 as base effects from the fiscal and monetary splurge to tackle the pandemic kicked in. The trend accelerated as the Fed's quarter program picked up and M2 contracted in December for the first time since the 1940s. But, if you listen to mainstream news, "Oh, the economy is picking up. Oh, it's doing better." See, this is why everybody need to ditch mainstream news. I mean, I've even heard that kinda stuff, and they're not telling you the truth about anything. Not telling the truth at all. Shrinking money supply is rare, but has been buried this year in a blizzard of market vitality around the Fed's aggressive interest rate hikes, and more recently, the bank shock that rocked the rates and bond markets, and the central bank's expectation. See that those bank failures earlier in March shocked the hell out of the entire market. It really did. And see, they came out, "Oh, we took care of it." Everybody should be at ease with your money. And as you can see, the public is still not at ease with this thing called banking in America. Mm, mm, mm. So, at least now, at least in this article, they are somewhat admitting how money problems continue to get worse. And the banking situation was really that was like setting off a bomb with gasoline up in this place. A mix of factors in the 1980s and 1990s included falling inflation, financial deregulation, and economy problems help loosen the link between the money targeting the GDP growth. Money supply was considered a less reliable basis of policy making. So now I don't know why they keep saying that we are post pandemic when we're not, but this is what they're claiming. And, they're saying, the Fed's equally dramatic push to tighten policies mainly via supercharged rate hikes, but also, It has a profound effect on bank customer deposits, reserve balances, and general liquidity in the system. The banking sector shock intensified some of the trends. By some measures, retail deposit outflows from US banks have been the biggest on record, particularly from smaller and regional banks. So, big time retailers also had their money tied up in these SVB and Signature Bank and First Republic, and even they grabbed their money and ran. So I don't know how these banks are gonna hold up. The smaller ones with this trend not dying yet, not fizzing out, I don't know how they're gonna survive what's going on. I don't know because 'cause they're the ones that are, and many of them, are already in the negative, because so many deposits have been removed from these institutions. Estimates vary, but hundreds of billions of dollars have fled these institutions. If deposits fall, banks must reduce lending to match their assets and liabilities. So the impact on M2 money supply is less clear cut. So, in addition, much of the deposit flow has gone into money market funds, which now boast a record balance of more than $5 trillion. But money market funds form part of M2. Further muddying the picture, money market fund flows make up a chunk of the $2 trillion plus that institutions park daily at the Fed's overnight reverse repo facility. There's still a lot of cash in the system, but much of it is stagnant. That's a big problem. This fits with data showing the demand for credit was already weakening and lending standards already tightening, even before the bank shock. So, y'all, all I have to say is at this point, be ready for anything. Be ready for anything. And you got countries stepping up saying they are ready to take down the US dollar. They're not saying they're ready 10 years from now, 5 years from now, 2 years from now. They're ready to do this now. And with the way money is flowing in the US, if they did it now, it would be an instant kill on the US economy. Because right now the economy is not strong enough to withstand something like that. It's not. It's not strong enough, y'all. So, I will definitely keep my eye on these type of stories. There's another one that I wanna bring out that I feel is really important, and I'm gonna do that one tomorrow. I just don't wanna do too many money stories in one day. So I just wanna spread it out a bit. So just look the next day for another financial story that I will be putting out. But y'all, please leave your comment and subscribe. Don't forget to hit on the notification bell, and I'll see you on the next video. Peace, family.